Um, joining me today is Toby Elegbede and Toby Elegbede from our research unit at Investment One, and Toby Additional from our mutual mutual funds business. Um, I'll let you meet our other speakers today. Toby, please introduce yourself to our viewers today.
Hello everyone, good afternoon. My name is Oluwatobi Elegbede. I'm currently a research analyst at Investment One Financial Services. Today I'll be taking us through the topic creating a balanced portfolio. I hope you all enjoy it.
All right, thank you. Also, I'd like you to meet our other speaker today, Toby Additional. Toby, please introduce yourself. Toby, okay, I guess maybe you may be having a network issue. While it comes up, we can well go into our topic today. Um, Today we are going to be hitting a very interesting topic, which I know a lot of our listeners will want to understand and want to know a lot about. We're going to be talking a lot about creating a balanced portfolio today, balanced investment portfolio, and Toby will be hitting us on a lot of details we would really need and breaking down the mystery that is investment. If you do not mind, Toby, please, the floor is yours.
Thank you very much for having me. Good afternoon everyone. Today we'll be talking about creating a balanced portfolio, and what I've done here is just to put a couple of slides together to make us get this easily. Okay, so without further ado, let me just go straight into the business of today. So when we say an investment portfolio, what we're talking about is simply a group of investments, a group of assets, which could include your bonds, your equities, real estate assets, and other alternative assets. Now, why do you own a portfolio? You own a portfolio to earn returns over a period of time, or you own a portfolio for it to grow in value over a period of time, or both. So that's basically what an investment portfolio is. An investment portfolio is a set of financial assets owned by an investor to grow in value or earn an income over a given period of time. So there are basically two types of portfolio. If you can see my slide, you will see that the first type is the strategic investment portfolio type. So this is basically owning a portfolio for a long term view, a long term horizon. While the second one is a tactical approach to portfolio investment, which is owning a portfolio for short-term buying and selling to make short-term gains. Basically, what we'll be talking about mostly will be dealing with the strategic investment portfolio, because as a firm, we always advise our clients, and we advise individuals to always take a long-term perspective on their investments, because it it's better to put it simply. It's better to put it simply. You will be able to overlook the short-term volatility in returns when you take a long-term view in your investments. Um, there are some major benefits of owning a portfolio. I think these days a lot of people have a lot of investments in different areas, but they don't treat it as a portfolio. I hope that by the end of this session you'll be able to treat all your investments as a portfolio. So what I'm basically talking about is you have some individuals that have investments in some shares. They also have treasury bills. They also have probably some FX, or they buy Bitcoin and stuff like that. But they treat all those investments separately. That's not the best way to treat your investments. You have to take a broader view at all your investments, and then look at all your positions um, as a given portfolio, not separately. So some of the benefits of owning a portfolio is the diversification benefit that it gives to the investors. So when you own a portfolio, simply you simply don't put all your savings in one basket. You don't put all your savings in one stock or put all your savings in one bond. This is what a portfolio will prevent you from doing. With a portfolio, you would invest in different areas of the market, and even in a particular market, you invest in different segments of that market. So, for instance, if you are investing in the equities market, you invest in different sectors in the equities market, like the industrial sector, the banking sector, the consumer goods, and all of that. And as well, when you are in the banking sector, you don't just invest in just one bank in the banking sector. You invest across some banks in the banking sector. These benefits relate largely with the third benefit that you can see here. That's the reduction in risks and volatility in return. When you own a portfolio, a well-balanced portfolio, you prevent your overall investments from volatility, from too much volatility, given the kind of economic environment that we are in. So let me try and give an example. Let's say, for instance, you're an investor and then you have most of your investments in a banking stock. Let's say you have 90% of your investments in a banking stock. In the moment where the CBN releases a new regulatory policy, there is a possibility that you experience volatility in your portfolio, because that regulatory policy can lead to some adverse effects in the banking sector at that very moment. So when you see that you find yourself in a negative position, or let me say not so good position, if at that moment you are owning a lot of banking names. However, if you had the balanced portfolio such that you had some banking names, you had some consumer names, you had some industrial names, probably some agri names as well, the losses that you experience in your banking names can be outweighed, or can be outweighed by the gains you make in other sectors. So that's the beauty of owning a portfolio. Another benefit of owning a portfolio is it helps you generate income. You can tailor your portfolio in a way whereby you gain income periodically, either quarterly or yearly, by investing in dividend paying stocks, or by investing in treasury bills or bonds. So this is one of the benefits of owning a portfolio, as well as it gives you a greater control over your financial life and your future finances. So, like I said earlier, some people have a lot of investment, but they treat them separately. They don't treat them as a portfolio. And that kind of way, you don't have so much control over your finances until you treat every of your investment as a portfolio. Let me give you an example. Let's say, for instance, you just heard from a friend that, okay, there's this particular investment that will give me 1,000, that will give me 10% in a month, and then you'll be like, oh, let me just put my money in this investment. It's possible that you make a gain from that investment, but at the same time, you're taking a lot of risks, putting so much of your funds in that investment. At the same time, you could need some amount of money before you make your gains from that investment. So there are some investments whereby you have to lock in your money for 3 months, 6 months, for a year, and then you already invested in that asset, and then you have your money locked up for a year. Meanwhile, you forgot that you had some expenses or some responsibilities to settle in the next 2-3 months. You notice that due to that emergency, you have to exit that investment, which you may incur some cost exiting, and then coming to settle your responsibilities. That's not the best way to run a portfolio. I think the best way to run a portfolio is to run it in a way whereby it's working for you, and then you have peace of mind. Going to the next slide, I'm taking us through how the steps you have to go through to create a balanced portfolio. The first thing to do in creating a portfolio is to know your needs and to know your risk tolerance level. The needs of a man can be different, given different stages of life that they are in. You can't compare the needs of a 25-year-old man that has a well-paying job to the needs of probably a man that is in his retirement age. Both of them can own the same portfolio. As well, a man that is a married man that has about 2 kids and is looking to pay school fees over the next couple of years, his portfolio will also differ from the kind of portfolio a man in retirement will use, or the kind of portfolio a single guy without so much responsibilities will use. So the very first thing you have to take note of is your needs and your risk tolerance level. What kind of person are you? Are you the kind of person that likes taking risks? Are you the kind of person that doesn't like taking risks? You have to consider, because it's very vital. If you are the kind of person that doesn't like taking risk, and then you have a lot of your investments in the equities market, it might not really work for you. In that you might not have the peace of mind. If you're the kind of person that you can't sleep at night, because you have one investment somewhere. Probably you should consider doing more of riskless investments, such as investing in treasury bills or bonds. So basically, you really need to consider your needs before you make your portfolio. For a 25-year-old, let me give you an example. For a 25-year-old man that just started a job and he has a well-paying job, and he doesn't have so much responsibilities. Probably his salary can handle most of his responsibilities. Such a person can create a portfolio whereby is tailored to growing in value. That is, the portfolio will be focused more on capital appreciation than on income income generation. Whereas an individual that is looking to settle a lot of responsibilities and doesn't have a constant stream of income, you have to go for a portfolio whereby income generation is the main purpose of that portfolio. There's also something very important that I must state in this planning stage. There's a difference between risk ability and your willingness to take risk. So for risk ability, what I'm talking about is, do you have responsibilities? Do you have a constant stream of income? If you have too much responsibilities, you might not be able to take a lot of risks. If you have a constant stream of income, you might be like, okay, I have a lot of money coming in this month, every month. I have a lot of coming in every month, so I can take this risk and I can take that risk. Whereas somebody 65-year-old that's about to retire may not be able to take that risk, because he might not have the ability to take that risk, because his stream of income is probably going to stop, and then he needs another stream of income. So you have to determine your ability to take risk by checking your stream of income, the amount of responsibilities that you have, and then your ability to take risk should match your willingness to take risk as well. By willingness statement is purely a psychological concept. I can be willing to take a 50% loss to make a 10% gain, whereas some people cannot take such risk. So given the kind of person you are, given the kind of your willingness to your ability, like I said, you need to match your ability with your willingness to take risk. Given the example of the 25-year-old guy that just got a job, now that's a constant stream of income without much responsibility. He has a high ability to take risks. That kind of person should also have a high willingness to take risk. But sometimes there are some people that, even with their ability to take risk, they can't take so much risk. But it's always good to be conservative. But if you don't have the ability to take risks, it will not be fruitful for you to have high willingness to take risks. Such that you have a lot of responsibilities, you don't have a constant stream of income presently. It does not make sense for you to have a high willingness to take risks. You have to match your willingness to take risks with your ability to take such risks. So when you are done with assessing yourself, when you are done with assessing your responsibility, your needs, you are done with assessing your risk tolerance, knowing the kind of person you are, the next step that you have to go through is the execution step. Now, the kind of person you are tells the kind of investment that you should take. If you don't want to take a lot of risks, you should look more at riskless investments like the government treasury bills or government bonds. If you're the kind of person that needs a constant stream of income, you should look at dividend paying stocks. There are some companies that don't pay dividends, and there are some stocks that pay dividend. So if you are somebody that you are looking for a constant stream of income, or at the stage of life you have a lot of responsibilities coming for you, and then you feel like you need a constant stream of income, then you should look at investing in bonds, and then you should look at investing in dividend paying equities. So there are other investments. There are other investment aspects to look at, like real estate. You can also invest in forex and all of that we have these days. Thanks to the rise of financial technology, you can do most of these things from your handset and from the comfort of your home. But I would like to talk about the things you have to do when you're considering equities or when you're considering bonds. If you're the kind of person that wants to invest more in equities, then you have to look at each company on its own. You have to look at the value, the fundamentals in each of these companies. Can this company remain in existence in the next foreseeable period? Can this company generate as much revenue, as much cash flow to keep the business running going forward? What kind of leadership is this? Does this business have? So these are the things that you want to look at. You want to look at the financial performance. You want to look at how much they're able to generate profits. You want to look at how much they're able to handle their cost and the level of liquidity that the company has. So you want to look at this for all companies that you might be interested to invest in. The same thing for your bonds or for your fixed income assets. You want to check the maturity of the bonds. You want to check the amount of interest or the amount of coupon that this bonds would give to you. If you are somebody that you don't need a lot of money, you don't have a lot of responsibilities, so you don't need a constant flow of income for now, you can invest your money on 10-year bonds. You can invest your money on 5-year, 7-year bonds. However, if you are the kind of person that you need that constant stream of income, you probably have the responsibility to settle into short term. Probably the best thing to do is to look at shorter dated bonds, like the 1-year bond, the 182-day bills. So that's basically it for bonds. You have to check the type of bond. If you're investing in a corporate bond or a commercial paper, you want to look at the credit rating of the company as well. So that's basically it. But one thing you have to take note of is the kind of person you are should determine the kind of assets you invest in. You don't just invest in any asset because you have been told that you will gain a high level of return from it. You invest in an asset because it satisfies your needs and because it will give you you'll be confident, and then it gives you that peace of mind. The next stage after the execution step. Okay, let me say something about this execution step before I go to the monitoring step. So, and let's say, for instance, you are a conservative person, you are risk averse, you don't like taking a lot of risks. Like I said, you do more of bonds, you do more of government bonds, more of government treasury bills. So you have to weight your assets. So by doing more of bonds, maybe you are doing 60% in government bonds, and then probably 10% in equities, and then you leave the rest for alternative assets, and then you keep some cash. But if you are somebody that you have no need for income generation now, you can probably, and you are also an aggressive investor, so you don't mind taking a lot of risk, then you can do more of equities. Probably put 60% of your money in equities, then you put about 30% in fixed income, and then you split the rest. You split the rest between your cash and other investments that may come your way. If you want to invest in equities, like I said earlier, there are a lot of things you have to consider, like the leadership of the company, the ability of the company to generate revenue and handle its costs. All those things, it takes a lot of time. You might not have the skill or the time to carry out those activities. That's why it might be best for you to look at mutual funds. It might be best for you to look at mutual funds. I think my colleague will talk about that when I'm done with this presentation. So there are lots of mutual funds you can look at. There's a money market fund. There's an equity fund. If you're unable to analyze these equities, you can go for an equity mutual fund like the VEIF. So you won't have to go through the stress of analyzing those companies on your own. You'll be leveraging on the economies of scale of investment one, because the assets that are invested in by VEIF has been thoroughly vetted by investment managers in the company. So after you have determined the kind of person you are, your needs and your risk tolerance, you have determined the kind of assets that you want to invest in and the weighting of those assets. The next thing you have to do is you have to monitor those assets. So when you start an investment, it is unlikely that it will remain, your weightings will remain so going forward. So it's possible that some of your investment lose value. It's possible that some of your investment gain value. So that the dynamism of the investment environment can change the level of weighting in your portfolio. Probably at the beginning of the year, you wanted to do 40% of equities. By the end of the year, you may find out that due to an high amount of gain, your equity is now about 60% of your entire portfolio. It's also possible that due to a high amount of loss, your equity is now about 35% of your portfolio. So you have to keep monitoring to ensure that the weighting of your portfolio remains tailored to your needs and remains and continues to help you. It's also possible that probably over the year or over a long amount of time, the portfolio you use today might not be the same portfolio that you have to maintain in the next 1 year, 2 years, because things can change. You might become the kind of person that likes taking more risks after 2 years. You might become the kind of person that likes taking lesser risks after 2 years. So you have to reassess again the kind of person that you are periodically, so that you can tailor a new portfolio to meet your needs. For instance, let's say you are a student at this moment, and then you are conservative. You have to be conservative, and then you do more of fixed income and less of equities. Then probably in the next 2 years, you get a well-paying job such that you can handle most of your responsibilities, and then you don't even have so much responsibilities apart from your personal feeding, your personal transport, and all like that. So the portfolio you use as a student will have to change when you have a new job. So that's where the monitoring comes in. You have to make sure that the portfolio I have now is fits my personality and will continue to help my future needs. So moving on to the next slide, I have some.
If I may, Toby, before we move on to the next slide,
okay.
Just a quick question around when you mentioned around monitoring. If in the case, like you mentioned, at the time when your portfolio, the stock value is 35% less than when you sell your portfolio, what's your best advice for the fellow who is maybe going from the students to the working class or something? What would you advise the person to do?
Sorry, come again with your question. I kind of lost you.
Okay, I was saying that you mentioned when you said the monitoring phase of setting up a portfolio.
Okay.
You said in a scenario where the portfolio holder has noticed the 35% loss secured by the stocks he has on his portfolio.
Okay.
What would you be your best case scenario for the person to move forward? Considering the person might be a student moving to becoming a working individual.
Okay, so I think that's one of the things that I still intend to talk about going forward. So probably I will talk about this after this slide. I'll give you an answer to that question. Okay, so this are portfolio samples here. I have a sample. Let me make a disclaimer. Now this is not a recommendation. This is just like a sample. This is something that you can use to probably guide your decisions. I'm not saying that you should take this portfolio as they are right now. Like I said, it's very important that you consider your needs and the kind of person that you are. So if you are somebody that that is very conservative, you might want to do up to 65 to 70% in your fixed income assets, then put them to 15% in equities, and then 0 to 5% in alternative assets. This kind of portfolio will fit you if you are risk averse than an aggressive portfolio. Also, if you're kind of investors that needs a constant stream of income, it might also be better for you to look at the conservative portfolio, since you can gain a lot of income from fixed income investments. So there's also an aggressive portfolio portfolio here. This is for individuals that like to take a lot of risks. If you don't like to take a lot of risks, you can't take on an aggressive portfolio. You will not have that peace of mind because you won't even be able to sleep. That's not how your money should work for you. Your money should work for you in a way whereby you are comfortable and you're confident in what you have put your money in. And also, like I said, you have to always match your willingness to take risks with your ability to take risks. If you don't have a constant stream of income and you want to go for an aggressive portfolio, it might not make a lot of sense for you because an aggressive portfolio actually has more risk in it. Although it brings greater return. If the higher risk you take, the more return you get. So if you're somebody that you don't have a constant stream of income and then you have a lot of responsibilities, it practically makes no sense doing a lot of aggressive investments. It will make more sense for you to be conservative than being aggressive. So let me answer the question that you asked me earlier. So you said for let's say for a student that you've experienced some kind of loss in your portfolio. Now, like I said when I initially started, there's this benefits in the portfolio, which I call the diversification benefit and the reduction in risk benefit. It's very likely that you experience a 35% loss on your equity position, and then the gains in other position will help you offset some of those losses. So at the end of the day, while you have made a 35% loss investments in probably one stock, it's possible that your portfolio as a whole or your investment as a whole is probably 5% up or 10% up. But however, if you experience that kind of thing as a student, like I said, before you make the decision to buy any equity position, you should do a thorough analysis. You should do a thorough fundamental analysis, financial analysis, and all of that. If you can't do that, I made mention of doing mutual funds. So if you have done your analysis correctly and you are still confident in that analysis, and then you have a long-term perspective, it's very possible that the 35% loss that you are experiencing is probably due to a short-term volatility, and then it's very likely that stock, if you choose a very good stock, it's very likely that stock can actually increase in value over the next couple of years. However, if you are at that point whereby you have to readjust your portfolio, you have to rebalance your portfolio, you have to go back to the planning level where you are able to say, okay, this kind of person I am, and this is the percentage amount I want to invest in each asset. Let's say you want to do 40% in each asset, then your investments you want to do 40% in equity investments, then you notice that your equity investment has dropped to let's say 35%. Then you have to take a look at your portfolio all around, and then you rebalance. You pick money from some asset and put in your equity position, or then you take money from your equity position and put in your fixed income asset, depending on how the portfolio moves. Like I said, there are different reasons why you might want to rebalance your portfolio. Your needs might change. Your psychology might change as a person. So if you can see my screen, you will see this portfolio that I kind of created here. This is a 100,000 naira portfolio. So this person wants to put 35% of his money in equities. The person started with 35% of the money in equities, 40% in fixed income, 10% in cash, and 15% in alternative assets. This is how this person started this portfolio, and this portfolio is tailored to the person's needs. This person is moderately aggressive. So this is how the person starts this position. As you can see, the person did not just put all his money in one equity stock. He puts it in 4 different stocks, and these 4 different stocks will most likely come from 4 different sectors. They should not come from one single sector. They should come from various sectors. So this is how this portfolio started for this person, and then at the end of the year, you can see some differences. You can see that the numbers are no longer the same. Stock A started at 8,750 and ended at 9,625. That's because stock A gained 10% that year. Stock B started at 8,750 and ended at 7,875. That's because stock B lost 10% that year. Stock C gained that year, gained about 30% that year to close at 11,375. While stock D gained 5% to close at 9,1875. And you can see that the total equity position now has reduced from 35% to 33%. There's a need for a readjustment in this case because this portfolio no longer aligns with what you have tailored for yourself at the beginning of the year. So you might want to readjust that. If you look at the fixed income also, you can see that the fixed income gained about 11% over the year to close at 44,400. You also see that that fixed income position has also reduced from 40% to 39%. So there's a need to do some readjustments in that as well. And you can see your cash position as well has gained 2% over the year from 10,000 naira, it's now 10,200. Meanwhile, your weighting has reduced to 9% from the initial 10% that you tailored for yourself. So, sorry. Okay, so this is how you go about the readjustments. So now that your portfolio has a new balance, you can see your new balance here of 113,000 compared to 100,000 which you started with. So now you want to readjust it using your initial plan, using your initial plan. Since your plans have not changed, since it's not like you have a new stream of income, you still want to maintain this level of portfolio. So what you have to do is now you have to work with this new balance that you have, this 113,000 naira, 662, 113,662 naira. You have to work with that figure now. So you have to now you reallocate 35% of that amount to equities. 35% of this 113,000 is 39,781, and then you divide that between your 4 stocks that you are invested in. You take 40% of that. You can see that your fixed income position is now 39%. Meanwhile, you want it to be 40%. So you take 40% of your 113,000 and then you reallocate it to your fixed income assets such that you now have 45,000 in your fixed income assets. The same thing for your cash position. You take 10% of the 113,000 balance and put it in your cash. And for your alternative assets, you take 15% of it. If you look at your alternative assets, you see that your alternative assets grew from 15% at the beginning of the year to 18% of the portfolio at the end of the year. So there's a need to reduce that alternative asset by 3%. So you take away 3%. Since you need 50%, so you take 50% of the 113,000 and then you put it back in your alternative assets. So this is how you go about rebalancing your portfolio. So I'd just like to give a brief overview of all I have said. You have to create a portfolio that is tailored to your needs. That's the first thing you need to do. Tailor to your needs and aligns with your ability and willingness to take risk. So when you know the kind of person you are, then you know the kind of assets that you want to invest in. You know the percentage of money you want to put in a particular asset, and you have to keep monitoring your assets as they move. It's possible that your portfolio deviates from what you have initially wanted it to be, given the economic environment. So you have to rebalance it. You might also have a new stream of income. You might have made money from somewhere, and then you feel like there's a need to readjust your portfolio. You might have new responsibilities as an individual. There's a need for you to readjust your portfolio. So those are the things you have to consider when creating a balanced portfolio. Thank you.
All right, thank you very much, Toby. Before we move on to talking to other, I want to ask you, what qualifies as alternative assets by you?
Okay, so when I say alternative assets, when I say alternative assets, or I say alternative investments, I'm talking about every other investment apart from equities, fixed income, and cash. Equities, fixed income, and cash are traditional investments. When somebody says I'm making a traditional investment, you're talking about putting your money in stock, you're talking about putting your money in bonds or treasury bills, or you're talking about keeping your money in a probably fixed income asset or keeping your money in your bank account. Those are traditional investments. So, but alternative investment is every other thing apart from those three I have mentioned. So, by alternative investment, we are talking about investments in agriculture, investments in real estate, investments in forex, Bitcoin. We're talking about all of that. Every other thing apart from equities, bond, and cash is alternative investment.
Thank you for breaking that down as well. Um, I'd like to have our listeners today just run through some of the products we have always mentioned in the past that would serve most of the purposes that these purposes we just mentioned. It's really quite important that we know that some of these things are available to you currently. As Toby has mentioned, you have what classes alternative assets. And for us, we also want you to know that some of these things are available to you currently while using the mobile application Zing that we've already offered to you. ZSave, which is one of the products we've always mentioned, classes as one of those products in the assets he mentioned earlier for the traditional investment, because it offers you fixed amount on your savings that is always available to you. The Z Plan product also enables you to do the same thing by saving over time for this kind of days. So you're diversifying your portfolio, looking at investing more in fixed assets. The plan also helps you do that. It also helps you plan in that direction. So if you are keeping a track record for yourself within the percentage you have outlined from what he said, you can also do that using a product like Z Plan. If you were listening to him, you would understand that a lot of these fixed income products serve the same features, the same purpose he mentioned. So you find yourself investing chunks of money you have held aside for the time being, say a year and likes. You can always do that with products like the fixed income, the Z Plan, the Z Save. I would like other speaker, Toby Adesina, to please speak to us today about the mutual funds products we currently offer as a company. Toby, are you there with us?
Yes, good afternoon. Can you hear me?
Yes, we can hear you.
All right, it's a privilege to be here.
All right. Okay.
Yeah. Okay, so let me start with mutual funds. Mutual funds pool resources, together to invest in a variety of asset classes. So the reason why I'm explaining this is, we've been talking a lot about treasury bills, a lot of fixed income instruments and all. So, as an individual, if you want to buy treasury bills, for example, you need a minimum of 50 million, if you're buying directly from government. But, mutual funds allow you, invest in treasury bills, invest in other fixed income instruments like bonds also, without having, that required amount of money. So we have a variety of mutual funds, and different asset classes. We have the short-term, mutual funds that are low risk, medium risk, and high risk investments. But I would start with the short-term, low risk investments, which is the Abacus Money Market Fund. Now, the Abacus Money Market Fund invests in treasury bills, fixed deposits, and commercial papers. Now, this fund was created for those that want to invest in, or it gives you an advantage of investing in all those asset classes, you understand, without having the required, minimum amounts. Now, this fund is very flexible. It works more like your savings account. Let me put it that way, in the sense that it is very flexible. It allows you ease of entry and exit. So, like your savings account, you have 5,000 naira in your savings account, for example. Okay, next week, you have maybe 10,000, you pay it into your savings account. So the money market works that way. You also need funds. You can say, okay, I need 5,000 from my investment. You withdraw 5,000 today. You still have that 10,000 that is earning interest for you. So instead of leaving funds in your savings accounts, not earning anything significant, you can invest in the Abacus Money Market Fund. Like I said, it invests in treasury bills, fixed deposits, commercial papers. Now, the aggregate of those investments actually gives you the money market rate, which is usually higher than what you would get from any of those individual investments. So presently, treasury bills for a year is around, say, 3.5%. But if you invest in the money market, you get around 4% per annum on the average, and that's because of the current market realities. Now, the fund, like I said, ease of entry and exit. The minimum balance to start is 8,000 naira. Subsequent top-ups, you can top up anytime. The minimum holding period for the money market fund is 30 days. So what we are saying is you are expected to stay in the fund for at least 30 days. After 30 days, you can take all or part of your funds whenever you want. And the dividends interest you earn on this investment is paid out on a quarterly basis. That's every 3 months. So you have the opportunity of recapitalizing your earnings or taking those dividends, straight to your bank account. So what we usually advise is, okay, for young people like us, you're earning salary or you have a business, you really don't need the dividends unless it is for a purpose. You understand? So what we advise is recapitalize your earnings. Let us reinvest the earnings. So what it means is your interest compounds at the end of every quarter. Now, mutual funds are regulated. Mutual funds in Nigeria are regulated by the Securities and Exchange Commission. So your funds, are regulated. So if you are scared of the security of your funds, you have no reason to. And the instruments we invest in are, they guarantee your principal. So the second fund, I'll talk about the Vantage Guaranteed Income Fund. Now, unlike the money market fund that is subject to volatility of the, the fixed income space, this, guarantees you 7.5% per annum. And this fund is benchmarked against the CBN standing deposit facility. Now, this rate changes only twice in a year, January and July. And that is dependent on the Monetary Policy Committee, when they sit to determine the monetary policy rate. So how we calculate it basically is the monetary policy rate plus or minus 5. Now, for the first half of the year, the VGIF rate, Vantage Guaranteed Income Fund, VGIF for short, guaranteed 8.5%. But due to the COVID situation and the economic reality, the Monetary Policy Committee reviewed rates downward, to 12.5. Now, 12.5 minus 5 gives you 7.5, which is benchmarked against CBN's standing deposit facility. Now, this is more of a medium-term fund. Like the money market, where you only need to stay for 30 days before you can access your funds. The VGIF, you need to stay in the fund for at least 6 months. Now, if you terminate before the 6 months period, you are charged 10% on your interest. Now, this also guarantees you, it also guarantees your principal and offers.
Sorry.
All right.
I'm sorry to break your thoughts there. You said charge 10% on your interest.
Yes. If you terminate before the 6 months holding period matures. Okay. Yeah. But after the 6 months, you can access your funds whenever you want to.
So I'm trying to help our listeners here understand what you meant by the 10%. So if we say from the first day of my investment, I have started accruing interest, right?
Yes.
So as at the time of termination, I would only be charged 10% of the interest I had accrued.
Exactly.
And my capital is still
guaranteed. Yes. Your principal is untouched.
All right, thank you.
All right. So the VGIF also is a mutual fund regulated by SEC, so your funds are guaranteed. Now, if the fund overperforms, at the end of the year, there is an excess return that is paid out to subscribers. Last year, 1.5% was paid out to subscribers. That is why I said if the fund overperforms. So it is not something you really put your mind on and say, but because looking at the current economic realities now, the COVID situation, Nigeria recorded, negative growth, so we are not really, or let's not too focus too much on the interest. But if it comes, of course, at the end of the year, the interest, the bonus is paid out to us. So you can imagine you invested in the VGI fund last year. Aside from the 8.5% that was guaranteed, at the end of the year, you were paid an additional 1.5%. Means it took your total to around 10%. Now, if you compare that to the average of the money market last year, the average of the money market last year was around 13%. You can see the guaranteed income fund didn't do that badly. But this year, the fund is at 7.5%, which kind of offers you like the best rate you can find in any mutual fund around. You can check. The money market fund is around 4% on the average, but this is fixed at 7.5% till the end of the year. I hope that is clear. So what else? So there's ease of entry and exit also for the VGIF. After 6 months, you can access your funds. You can top up anytime you want to. And of course, these products are available on Zing. You can monitor your investments. You can see how your interest grows on a daily basis. If you need to top up your investments, you can do that via Zing. If you need to redeem funds, you can also do that via Zing. I hope that is good.
Thank you very much, Toby. I'd like you to just give us a bit. If one were to visit our website, I'm sure they will find information on BDF, on VBF, and the likes. I'd like you to just give us a bit of info on that, so that people who are currently listening know at least a bit about that as well.
All right. So like I mentioned earlier, we have different kinds of mutual funds that invest in various asset classes. I talked about the money market and the Vantage Guaranteed Income Fund, which are short to medium-term investments, and guarantee your principal. Now so let's assume you are willing to take a bit of risk. Like the former speaker said, you invest in stocks, and maybe you do not have that time or the technical know-how, to sit down and select stocks on the Nigerian Stock Exchange. You can invest in the Vantage Equity Income Fund. Now, the good thing with this is it is managed by thoroughbred professionals. They sit down, they invest in blue chip stocks. We're talking about the top 20 stocks on the exchange, stocks with good corporate governance, stocks that pay dividends, so you are sure that even if, we all know the capital markets, we all know how volatile it is, but still the returns in that space is even doing better than what you find in the fixed income space. Like, for example, I know Zenith Bank, GT Bank, and co declare dividends above 10% this year. So the Vantage Equity Income Fund is for those that do not want the hassle of having to select stocks. You invest in the fund, and our professionals invest in good, dividend-paying stocks on your behalf. But these funds, of course, the stock market is volatile. These funds do not guarantee your principal. They are high-risk investments. So if you are willing to take a little bit of risk, then you can invest in the Vantage Equity Income Fund. We also have another mutual fund, the Vantage Balanced Fund. So from the name balanced, so it invests in a bit of all the asset classes available, a bit of fixed income instruments, money market instruments, a bit of the capital market also. Now, because this is balanced, it reduces your exposure to the stock market. So, for example, the stock market goes down, it has reduced your exposure. By investing in this fund, you've reduced your exposure to the stock market. And, let's assume the fixed income, front is doing very well. So, it balances out, so it means you enjoy best of both worlds, for the Vantage Balanced Fund. Of course, it is also a medium risk investment because you can lose a bit of your principal if, things go bad, if the stocks go bad, if you understand. So the final one is the Vantage Dollar Fund. Now, this is for those that want an alternative kind of investment, investments in dollars. This allows you invest in Euro bonds. Now, to buy Euro bonds as an individual, you need a minimum of $200,000. So what this does is it allows you to invest in Euro bonds, corporate bonds, sovereign bonds, you understand, without having that $200,000. The minimum to come in here is $500. And this is, this is for those that have maybe future plans, in dollars. So maybe you want to do your master's abroad, you are saving for your child's tuition abroad or your vacation abroad. So we advise people like that to invest in the Vantage Dollar Fund. So that's basically all our mutual funds. Well, all the mutual funds are regulated by SEC, and very soon the Vantage Dollar Fund will be available on Zinc. So if you're interested in the dollar fund, minimum is $500 and subsequent top-ups, from $1. So this is more like you're diversifying your portfolio. You understand? So, and this also helps you hedge against maybe the fall of the Naira. Like we can see now, Naira is, hovering around 470, 480. So imagine you already had, dollars, invested in a dollar fund, So aside from the fact that you are hedged against the fall of the Naira, you're still earning, interest, by investing in the Vantage Dollar Fund.
All right. Thank you very much, Toby, for the breakdown.
All right.
We do have some questions from our listeners currently.
Okay.
I hope our other speaker is still available so we can ask some of the questions that people have. So we have a question that says, what is the minimum amount one can use to kickstart investing in treasury bills or bonds or equity?
Okay. So like I said earlier, if you are buying any of those funds individually, treasury bills or bonds, for example, you'd need a minimum of 50 million if you're buying directly from government. But if you're investing through the mutual funds, assuming you want to invest in the money market fund, for example, the minimum is 8,000 Naira. And the money market fund invests in treasury bills, fixed deposits, commercial papers, and other short-term money market instruments. While for the bonds, if you're looking for something that has an exposure to bonds, you can invest in the Vantage Guaranteed Income Fund. The minimum to start is 50,000 and subsequent top-ups from 5,000 Naira.
Okay, I'm going to go on a limb and guess that the question here also covers the assumption that he or she does not want to invest in a mutual fund. How much do you would you say I would require to buy a treasury bill with investment one, for instance?
Okay, so from as little as 100,000 Naira, you can buy treasury bills.
Okay. Is Mr. Ligbide still available? I'd like you to answer how much would be like the minimum for entry into the equities market.
Okay, so for the equities market, I think to open a stock, you need to have a stockbroking account to invest in the equities market first things first. And then to open a stockbroking account with investment one, I think the minimum amount that you need is 1,000 Naira. Yeah. So if you can open an account with 1,000 Naira, you can invest in the equities market with 1,000 Naira. You have a lot of stocks that are trading at 25 Naira, 15 Naira, and all that. So 1,000 Naira is the minimum amount to invest in the equities market.
All right. Thank you very much. So it says, I think we've answered this one already on rebalancing portfolio. So what is okay? So I have a question here that says the person actually goes ahead to say it first that he's just being curious. So why is Z Plan or Z Safe Interest better than Abacus Money Market Fund? What is the underlying asset in the Z Plan and Z Safe? So I think I will start by answering that part of saying Z Plan and Z Safe are mirror-like investment for fixed asset investments. So they are not exactly classed by following the standards the mutual funds will follow. These assets only, the reason why the interest might be that high is because it has the liberty to invest in a diverse entry of investment tools to have open to it. And that is only at the discretion of the fund manager. So if at the point the fund manager tells us that the rates have gone down, we need to reduce it, you will find that the Z Plan and the Z Safe rates will follow suit. I hope that has answered your question, Mr. Otobong Gideon. Hi guys, please can I get a copy of the presentation? Yes, the presentation will be available to you after this. A video of this will be available to you after this has been completed. So you can look forward to that in your mail. And the question, this question also goes, what is the rate on the VDF?
Okay.
Mr. Can you help us with that?
Okay, so the VDF uses a year to date, so a performance of the fund over a period of time, usually from beginning of the year till date. And for this year, it was projected to do around 4 to 6%. So there is no exact rate like the money market fund or the Vantage Guaranteed Income Fund, for the dollar fund.
Okay. Thank you. I see here, it said how many years is the Vantage dollar fund?
Okay, so the minimum holding period for the Vantage Dollar Fund is usually 6 months, but it is a long-term investment. So we usually advise, for people that have a long-term, plan in mind, So let's say usually from a year and above, for you to really enjoy the benefits of the dollar fund.
Okay. The question also extends to ask, how can I invest in Vantage Dollar Fund since it's currently not available on Zoom?
Okay, so you can get in touch with us. Would send you the account opening form, or we'll send you the account opening link so you can fill the form online, and we open your dollar account for you.
Okay. Also to add to that, if you are very interested in getting across to maybe start your investment journey with the Vantage Dollar Fund, you can always contact our customer care lines or send us a mail at customercare@investmentone.com. However, was supposed to be kept as a very well packaged surprise, but VDF is coming to Zing very soon. So you might not have to go through the whole hassle of sending a mail or making a call. You might just get it on your app before you know it. So this question goes, between mutual and stock, which one is more preferable to invest in for a beginner? Mr. Alegudi, I think that's going to you.
Sorry, come again.
It said between mutual fund and stocks,
okay,
which is more preferable to invest in for a beginner?
Okay, so that depends on the kind of beginner that you are. A beginner can be 65-year-old, a beginner can be 30-year-old, a beginner can be 25-year-old. So I'm not particularly sure the kind of beginner that you are. So I'll try to answer this question as best as possible. So if you are a beginner that is 25-year-old and then you probably have a job, or a constant stream of income, you might want to look at equities if you can take the risks in the equities market, or you can just do a mutual fund. If you are conservative at that age, you can do a mutual fund. So it actually really depends on the kind of person that you are. With a mutual fund, then you are hoping to gaining a regular stream of income. If you don't need that regular stream of income, you might want to do equities or any other investments. So as a beginner, it actually depends on the kind of beginner that you are to tell if you should do a mutual fund or an equity investment. An equity investments, all you just have to understand, the difference between these two is that the risks in the mutual fund is lower than the risks in the equity investment. Although it depends on the kind of mutual fund you're talking about. Say if you're talking about the money market fund, so just like Abacus or let's say Vantage Balance Fund, the risk there is lesser than what you get in the equities market. But in the equities market, because you're taking higher risks, you are open to making a higher amount of return. So it actually just depends on what works for you as a beginner. There's no general investment pattern for a beginner. But like I said earlier, if you don't have the time to go through all the analysis of equities, you might just want to go for a mutual fund.
Okay, thank you very much. I have a customer here who is asking about investing. What you mean by term per annum. I'm assuming he means, what do we mean by per annum when we are talking about interest? I don't, would you be
Okay,
like to
so
that?
per annum just means per year. So when somebody tells you you're getting 10% per annum on probably on the 100,000 naira, it means you're getting 10% of it, 100,000 naira per year. So it means you're getting, if it's 100,000 naira, that means you're getting 10,000 naira for that year.
Okay. Thank you very much, everyone, for joining in today. If we have more questions, I'm sure we have a lot more questions. Customer care representatives are always willing to pick up the call and answer whatever you need. And if you'd like a very detailed explanation, you can send us a mail, and other details about investments, particular investments you can take part in, can be sent to you and for you to take part of. Other things you might also need will be available on the Zing app, whether it is immediately or in a very short future. We thank you very, very much for joining us again today, and we look forward to having you again on our next webinar. Thank you and have a very lovely day.
Thank you.